Hello all, welcome to Universal Group of Institutions, Bengaluru. Today we are discussing an important topic of economics known as ways and means advances. See, recently, in recent months, the Reserve Bank of India has decided to increase the aggregate, there is overall total WMA limit of states and union territories to 60,000 crore. So, in this topic, we are going to understand what exactly are ways and means advances, what is the history associated with the ways and means advances, why ways and means advances are essential, what is the purpose behind the introduction of the WMA, and what was existing prior to the WMA. See, to understand about the WMA, we need to first understand what exactly is the central bank of a nation, be it Federal Reserve System in United States of America, be it Bank of England, be it Bank of Japan, be it Reserve Bank of India. All these central banks of these nations fulfill certain basic functionalities. Those basic functionalities are ensuring price stability, that is ensuring that the inflation will be in the limit range. That is, with regard to India, we have the idea of 4 plus R minus 2. Okay, that is the range of 2 to 6%. It is to ensure the financial stability, to ensure the developmental functions. I mean, it supports through the various institutions like NABARD and all, and it also oversees the foreign exchange reserve. The one function in which today we are very much interested is the currency and banking functions. See, the Reserve Bank of India act as a banker to the banks as well as the governments. That is, the Reserve Bank of India has two important clients. Client number one is government. Client number two is the banks. The Reserve Bank of India ensures that none of its clients, that is, be it government, be it banks, never face any liquidity crisis. That it ensures that the government's liquidity needs are being met. That means the framework, the liquidity framework that has been designed by RBI is such a robust and dynamic that none of its clients face any liquidity crisis. That means whenever there is a mismatch with regard to the receipts and expenditure of a government, the Reserve Bank of India is going to rush it. One such requirement, the requirement of funds for a short period of time. That means it has so intelligently created a framework. There are tools which are going to fight the liquidity crisis needs during a short period of a time. There are tools which are going to take care the liquidity needs for a long period of a time. So, I'm more interested in understanding what are the tools that have been designed to fight the short-term financial needs of a government. That is, a short term here is liquidity needs for less than one period. Now, here the government has designed the Reserve Bank of India has designed various tools. The one prior to this, right after the independence, we had a system called as the ad hoc treasury bills. The idea of ad hoc treasury bills was originated at the heights of the Second World War, that is 1940 and 41. And again, this idea was continued and started in the mid 1950s. The ad hoc treasury bill was designed to ensure that the government never face a liquidity crisis for a short period of time. So, this ad hoc treasury bill was discontinued in the year 1997. Instead of ad hoc treasury bills, we decided to came up with the ways and means advances. So what exactly is the ways and means advances? How it is going to ensure the liquidity needs of a thing? Here we have three kinds. One is special WMA, special WMA, that is being also called as the SDF, special drawing facility. Another one is the normal WMA and the overdraft facility that exists. Special WMA, normal WMA, and the overdraft facility. See, whenever the states and central government require a fund and there is a mismatch for a period that is less than a 90 days, they can approach the RBI and they can get the cash supply. So the first available window for these union government and state government is the special WMA. As and when the limit under the special WMA will be reached, they have to access funds under the normal WMA. When the limit of normal WMA is also reached, then the overdraft facility will be available to these. So how the interest rates are going to be applicable? What are the interest rates that are applicable here? We look at now. For example, under this special drawing facility, as you can clearly see, special drawing facility, if it is availed against two of the important fund, that is a sinking fund and a guaranteed redemption fund, the interest rate will be repo rate minus 2%. Why? Because based on the recommendations of the 12th Finance Commission, each state is supposed to maintain these two important funds, that is CSF and the GRF, that is Guaranteed Redemption Fund. If the loan is availed against the government security or the auction treasury bills, the interest rate will be repo rate minus 1%. So since it is available against the interest rate that is available against the CSF and GRF is less, the states will be encouraged to maintain a great balance with regard to these two funds. And once the limit is reached, there is a normal WMA where the interest rate is as equal to the repo rate. If it is outstanding is beyond 3 months from the date of banking, it will be repo rate plus 1%. In case of the overdraft facility, that is once you reach the limit under the WMA, it will be the repo rate plus 2%. If it exceeds 100% of the WMA, then it will be repo rate plus 5%. See, as I said very clearly, this has been designed to fight the liquidity crisis. Whenever there is any economic crisis, Reserve Bank of India is going to offer a concession to both union government and a state government by increasing the OD days as well as the increasing the limit. For example, let me show you. During the time of COVID-19, the OD days time limit was increased by the Reserve Bank of India. See here, the earlier overdraft was for only 14 continuous days, that has been increased to the 21 days. And that is, in a quarter, the earlier overdraft, limit that was existing, that was increased to from a 36 working days to the 50 working days. So as I said very clearly, whenever they face any liquidity crisis, they are going to increase the overdraft facility. So what we have learned till now is what exactly is the WMA, how this provision of WMA is applicable or is available. The Reserve Bank of India, from effective of 1st of July, has decided to increase the overall aggregate WMA limit for the various states. As you can see, the limit that is existing for the state of Andhra, state of Bihar, state of Haryana, state of Karnataka, state of Meghalaya. These limits are decided based on the expenditure of these states in the recent years. You can see in some of the, earlier, they used to understand the expenditure for the 3 years and based on that they used to decide. But the working group that was constituted which was constituted in 2024 has decided to look upon the expenditure in the recent years, and based on that they have decided to increase the WMA limit for these states. So till now what we have discussed is what is the concept of a WMA? For very simple, it's a ways and means advances which has been designed to find the liquidity needs for a short period of a time. The window that is existing is the 90 days. There are three things that exist here: normal WMA, special WMA, and the overdraft facility. The first thing both central and a state has to exhaust is their special WMA. Once they exhaust the limit under the special WMA, then they can go to the normal WMA. Once they breach or exhaust that normal WMA, then they can access fund under the overdraft facility. And we have seen what are the interest rates that are existing and how the overdraft number of days was increased in the wake of COVID-19 pandemic, where the government revenues were dried up and the expenditures started to increase. So that's it from our end. Thank you. Keep watching our channel.